with Jörg and get a little bit of insight from him. Jörg, for those of you who don't know him, has lived for, what is it, more than 30 years in China. Yeah. Was the head of the European Chamber of Commerce there, worked for the German chemical company BASF. Just a fantastic, legendary China hand. Has now moved to Washington, D.C. Give us an EU kind of DC perspective right now on what the Trump victory means for US-China relations and EU-China relations.
Well, thank you, Clay. I would say the view out of DC is everything is in flux. I mean, first of all, US-China, is Biden going to meet Xi Jinping in Brazil at G20 this week, for example, is a big question that we all have. Secondary, of course, who's going to be appointed into Trump's cabinet, who's going to be Treasury, Commerce, and there was always the name Lighthizer out there. Is he going to take USTR? Understand that he's not very keen to take that place again. But what else is there left for him at this stage? So it all depends on that place in the cabinets. We have hawks that will not be coming back into the administration, like Pompeo, like my friend Matt Pottinger. So that means that the Taiwan question might be viewed differently with this lineup of less having Taiwan supporter in the new cabinet. And then, of course, when it's going to come the tariff tsunami, Trump talked about 60% on China products. That's a $430 billion US. So I will guess that he has to do 60%. But again, on which part? Is it going to be a quarter? Is it going to be staged in 25, 26? I think that he cannot afford to have 60% of all the products coming in right away. And then, of course, the figure of Elon Musk. If you have someone who actually has access in Beijing and to Trump is one person, is he going to be sort of intermediate? Is he going to be back channel? It's hard to imagine with this character that he's going to be back channel, And on Europe, we have everything in flux. I mean, we have the weakest political leadership in Europe ever. My own country, Germany, possibly is facing elections in January, February. We might have a new chancellor. His name is Merz. I briefed him a couple of times. He's a former investment banker. He's a former business person, so there might be some rationality there. Europe is just in the last stages of appointing the commissioners. They might be more powerful than in the past, given the weakness of Paris and Berlin. And then, of course, the big difference between Europe and the US will be the openness for Chinese direct investment. Europe is very keen to have Chinese investment. The US pretty much has closed the door.
Very, very quickly, your point about Elon Musk is a really interesting one. The Trump administration is going to be very hawkish on China. It has boasted about that. Does that make life very complicated for Elon Musk if he's a part of that team, and he's also running a giant gigafactory in Shanghai and trying to sell cars to Chinese consumers?
Well, I'm puzzled. I mean, he's deeply embedded in China. 25% of his turnover comes from China. At the same time, he stands for EV, but he's with the president who stands for old energy. So I don't know how that's all going to shape up in this respect. I don't know.
Very interesting. Fred, I want to come to you next. One of the most talented macroeconomic observers of China that I know. China's economy not doing very well lately. There has been an effort since late September to turn it around. The government is trying to signal that it gets it, that it wants to fix things. On Friday, I guess it was, it announced a $1.4 trillion stimulus package. The markets are kind of underwhelmed. What's your view about what ails the Chinese economy and how committed are leaders in China to sorting it out and fixing it?
Yeah, so Chinese economy clearly face a number of challenges, like housing, local debt, deflationary pressures. I do think since September, the government has started to, at last, take actions on the policy front, trying to address those challenges head on. Not surprisingly, the markets are initially excited and then become a little bit disappointed, if you may, by the magnitude of the policy package. And in my view, more importantly, the composition of the policy package. So in terms of magnitude, like in September, the central bank PBOC cut the policy rate by 30 basis points, and the mandatory reserve requirement ratio by 50 basis points. I would have expected at least double, triple, or even quadruple like the magnitude, right? Because the economy facing some real sharp signs. You need to be resolute, decisive, and get ahead of the curve. So certainly magnitude has much to be desired. On the fiscal front, the same, various bits of information come out by the government, adding together could be anywhere between 2 to 6% of GDP. Again, if I were driving policy, would it be north of 10% of GDP? You need to be big enough to convince anyone, right? The government is serious about fixing the economy and turn it around. So like the magnitude, I think work to do. Then the compensation, for whatever the reason, the government is still kind of fixated with supply side. Anything do more infrastructure, more capex investment, and it doesn't take economists to know the trouble China faces is not supply side. China has world-beating manufacturing industry.
Right.
Is the demand side, particularly domestic demand, right? That's what the government needs to do. And but I'm hopeful, the actions they have taken so far, show the government does care about the economy, and they are very serious turning it around. And I do expect a lot more policy actions to come on stream, on traditional, monetary, fiscal, but importantly, on the structural and the reform side, China needs to convince its own consumers, middle-class consumers, convince its own private sector entrepreneurs, and of course, international investors, multinational companies. China remains committed to a free market economy. Anything otherwise, backtracking, deviating from that goalpost, China wants to be a US-style, dynamic, vibrant, entrepreneurial, free market economy. Anything that deviates from that, I think China will find it very hard, to turn around fundamentally.
Yeah. Zoe, you've written a lot about this point about consumption that Fred mentions. Zoe, very keen observer at the Council on Foreign Relations about China, and you've written about what you call the kind of doom loop between the kind of underconsumption and overcapacity in China. Can you elaborate a little bit on what you mean by that and where you see that doom loop headed?
And first of all, I want to clarify, yes, I did talk about the doom loop, and the market did pick up on that, but that is by no intention saying that this is definitely going to head towards that direction. But there is a risk of doom loop, starting with the plan-oriented political economic system.
Right.
And if you look at China's 5-year plans, every 5-year plan starting from the 9th one to the 14th one, over the past 4 decades, there is always a section talking about how much market share by which year China wanted to achieve, and in terms of specific sectors. In other words, over the past 4 decades, when Deng Xiaoping started to introduce market system into the Chinese market, it had a vision in terms of building up China's strategic competitive manufacturing base, and the system has just perfected itself over the past 4 decades. And without an emphasis or a specific attention to boosting consumer market, this system at this specific moment is going to be, especially going back to Fred's point, in terms of asking private consumers to spend more. That is equivalent to ask the system to do exactly the opposite of what it is supposed to do. So it is going to be difficult. And then at the local government level, you have this campaign-style growth, meaning everybody wanting to make sure that I am doing my share to reach the target, to reach the performance. Therefore, you always end up with overshooting. And then, obviously, at the company level, across board, you end up having this fierce market competition. Domestically speaking, profit margin is so thin that companies, CEOs, executives, they have the incentive, regardless of Beijing's support or not. Companies have the incentive to go abroad, to sell overseas. Obviously, Beijing sees this as an opportunity. You end up having Beijing's support. So right now, China is at a very interesting point in the sense that you have a lot of existing investment. You build up a lot of strategic manufacturing base, And a lot of this so-called overcapacity aspect, they wanted to move overseas, whereas the newly strategic sectors are also booming. Now it's a race in terms of the relative speed, right? If the domestic, newer emerging sector, they can grow faster than the older or sort of outdated or overcapacity sector can move overseas. So this can sort of like escape the doom loop.
Jing, one of the premier investment bankers in the world, now based in New York for JP Morgan. You talk to corporates all the time. A lot of big multinationals, many of them regulars on our Fortune 500 list, have heavy exposure to China. Give us a quick overview as to what those big corporates are thinking now about this different environment in the Chinese market that's very changed from what we saw in terms of pre-COVID.
Absolutely. So Fortune 500 companies, by and large, all have exposure to China. Some have exposure in terms of revenue and profit generation. Others have exposure in terms of supply chains. So in terms of revenue generation, some sectors are more exposed to China than others. So for example, the semiconductor industry, industrial companies, consumer companies are very exposed to China. Some of the companies generate anywhere between 10 to up to 50% of revenue from China. And then on the supply chain side, given for the past several decades, China has emerged as the world's manufacturing powerhouse, many of the companies still have substantial amount of supply chain in China, not just final assembly, but also components. So for example, in the pharmaceutical industry, China still produces a lot of the active ingredients for antibiotics. Consumer electronics, roughly 50% of consumer electronic products in the US are actually linked to China. So when multinational companies look at the changing geopolitical landscape, they still want to do business with China. They want to stay in China, but they want to de-risk their exposure in terms of revenue, but also in terms of supply chains. So when it comes to diversification, I want to make the distinction between de-risking and decoupling. Mm-hmm. De-risking is much more nuanced. Decoupling basically means you're severing economic and business ties, which is not feasible in this environment. Now, how do multinational companies de-risk their exposure? Number one, if they have too much revenue coming from China, they should think about investing in emerging markets, in the US and allied countries a lot more so that they can reduce their overexposure to the China market. And in terms of supply chains, quite a few multinational companies, not just in the US, but also in Europe, are pursuing what's called a China Plus One strategy. They keep their supply chain in China, but they also diversify the supply chain to countries like Mexico, like India, Southeast Asia, which have been beneficiaries of supply chain movements. Also, if you think about de-risking, some of the multinational companies are thinking about pursuing more of a China for China strategy. Mm-hmm. I'm referring to companies in the consumer sector. So if you are an apparel company, you want to design products in China which have more relevance for the local Chinese consumer. Therefore, you employ local designers, you produce locally, you sometimes perhaps even introduce Chinese cultural motifs into the designs. And these types of China for China products resonate much better with the Chinese consumer.
Can I ask you just a quick question on that? Because you raise the question of sort of localization, and often the secret to successful localization is having the right partner in China. And what we've seen historically with a lot of multinationals is that they've been forced to take a multinational or a local joint venture partner. They've hated it, and they've spent their decades lobbying to be released from this tie-up with the local partnership. Do you now see from a kind of an M&A standpoint that JV alliances are back in fashion?
It's ebbs and flows. In the initial stages of China opening to the world, multinational companies sometimes had to partner with a local company. In the automotive industry, everyone had 50-50 JVs, even
They
in
haven't
retail
worked out
sector.
so well, though, right?
But now it's changed because for some time, multinational companies preferred to have wholly owned entities in China, which they could absolutely control. These days, many multinational companies are choosing to have a local partner, private equity funds, or local parties that have good connectivity with the local community, with the Chinese consumer. So we're advising some of our clients to de-risk by actually perhaps selling a portion of the China business to a local joint venture partner who can not only make the multinational company much better connected to the China market, but also this is a form of de-risking.
Yeah.
So joint ventures, as you said, Clay, became unpopular. But I think in this new geopolitical environment, they've become more of, they've become one avenue for multinational companies to de-risk their exposure to the China market.
Fred, I want to come back to you and ask about the impact of tariffs. As an economist, you look at this pledge by President-elect Trump, 60% across the board tariffs on all Chinese products, not just selected sectors. How much will that hurt the already kind of struggling Chinese economy? And do you anticipate that if Trump goes through with that, all 60% across the board, how will China retaliate?
Well, so this is clearly a risk looming very large on the horizon, right? Especially given the domestic challenges, Chinese economy facing. But the tariff, maybe I'm a non-native English speaker. To me, it sounds like a very ugly word. But I think
Trump says it's a beautiful word.
It's a beautiful word.
It's the most beautiful word in the dictionary.
To my limited knowledge of English language, right? Generally, if you look at the history, right, tariffs have always done more harm than good.
Yeah.
Right? In this country, in the 1920s, 30s, the Hardy Smooth Tariff Act really, plunged the U.S. and the world economy into the abyss of, depression. Right? And actually, ultimately, I would argue, paved the way for the rise of Nazism and worldwide. So it could be very dangerous. I understand the sentiments, right? There's a lot of grievance against China and blah blah blah. But I think given the stake, how high, I hope, like what Gary Cohn alluded earlier, maybe through negotiate discussion, but. Tariff 60%, that's very steep. That's like by magnitude, 2x above the Hardy Smooth, average tariff rate back in the 1920s, 30s.
Wow.
And we're talking about the two largest economies in the world, right, engaged in this like very steep tariff. And if China, obviously this is very bad, but China's responses also matter. If China chooses to retaliate, as it did in the first trade war, in the first Trump administration, that's just lose-lose. And then in a global ramification. Yeah. So I hope this time, no matter what President Trump elect is going to do, right, I find it hard to predict his policy actions. Yeah. But if to follow through his campaign pledge, if I would urge the Chinese, stay cool, not to do, if someone shoot at the left foot, you should not by retaliate and shoot your own right foot.
So look, Zoe, I want to ask quickly, there are some people that make the argument that in fact, this time around is different from the first Trump administration in that China is much less dependent on exports to the United States. It's actually reduced the percentage of its exports that go to the United States and has been fairly successful over the last 8 years in diversifying into exporting to other economies. Now, some of that is probably because it's being routed through Mexico or on its way to the US. But do you think that China can kind of shrug this off, diversify, export to other economies, Southeast Asia, India, the Middle East, elsewhere, and just be fine? There's also this argument that, in fact, Trump might be doing China a favor by forcing it to learn to become more self-reliant, and then it won't really be dependent on the US at all.
I do think that China has been trying a lot to do self-sufficiency, regardless Trump or not, right? Starting from Hu Jintao era, the idea of self-sufficiency, self-reliance has always been there. Given that China is now about 30% of global manufacturing, and the last time the United States was about 30% of global manufacturing was in the aftermath of World War II. So from that point of view, China cannot sufficiently or just by absolute measures to diversify away from the United States. And for a lot of the reasons in terms of de-risking, as Jim mentioned earlier, it's really about finding the tariff mitigation countries from Mexico to Vietnam to Morocco, trying to figure out how to bypass those areas. So from that point of view, I really don't think China can directly export to the United States, or for that matter, that number is going to continue to, if not decline, it is going to stagnate. And by the way, Trump is very much focusing on bilateral surplus, trade surplus. But during his first term, trade surplus with the United States, with China actually went up. So I do think that the 60% tariff is going to be his negotiating bargain. And the executive branch, he does have the power to unilaterally say the number is going to be 60%. In other words, the risk is there. But to what extent, it really takes President Xi Jinping hopefully his own diplomatic and statesmanship trying to walk back and de-escalate.
Jing, I see you nodding. Yeah.
I think China itself has been trying to de-risk its own economy for the past several years. So if you look at the statistics, China's exports to the US as a share of China's total exports has been going down. Because Trump first imposed the tariffs in his first term. So the Chinese economy has been adjusting by increasing exports to the rest of the world, especially the global south, and reducing its exports to the US. And in the meantime, the Chinese government has been trying to really spur domestic consumption because, of course, as we said, there's a very large manufacturing base in China, but consumption is still lagging. So they have been introducing proactive measures to spur domestic consumption to absorb some of the capacity in China. And supply chains are becoming, as we said, very fragmented. Inflation would go up in the US. If tariffs go up, that's natural. So that's why everyone, all the multinational companies we speak with, are really building more redundancy into their supply chains. They want to have the Americas, Mexico, Brazil serving the US market. They want to have China for China, and then maybe Turkey, Poland, Hungary serving the European Union. So we are definitely seeing supply chain diversification for the past several years, and perhaps it's accelerating.
Jörg, I'd be curious to hear your perspective on that. I'm particularly interested, we've just got a few minutes here, in two questions. Electric vehicles, where China has massive overcapacity, but really is designing amazing cars that even if you slap 100% tariffs on them, are actually very competitive. And if you have the lower tariffs that the Europeans have, they're still an even greater threat in the European market. Where do you see that going? And then maybe very quickly, a prediction, what happens to TikTok? The deadline is right after the inaugural. Does the US pull the plug or not?
Yeah. Well, on car industry, the global car industry based in China asked the question, should I stay or should I go? And we see companies leaving, the Koreans, the Japanese scale back, also Ford has more or less left.
It's been very dramatic in the last couple of years.
The German companies decide to hang in there, and they want to actually unlearn how to build cars and try to establish a learning curve with Chinese partners to build mobile phones on wheels. And so there is this real shift, and that's why these billions go into the Chinese economy from these companies, including chemicals, in order to actually catch up. We're 2 years behind on body, we're 6 years behind on digital. And that's why Volkswagen doesn't have a joint venture with XPeng. They actually asked them to design the body with them in order to speed up. It's all about trying to be still competitive, not only in China, but also in the global south. Because even if the US and Europe are closing down, Europe will not close down. But still, we have the global market where the Chinese products will eventually wipe out our cars. So I would say the learning is really staying in what I call the China Fitness Center on EV, in order to stay relevant for the game, because Chinese cars are incredible. And last point on TikTok, actually, I don't know. I mean, you see Trump saying, you know, TikTok should remain, and at the same time, the Biden administration actually wants to shut it down. I have no clue. I just know that my kids use it too much.
Anyone else have any guesses on TikTok?
If I can chime in very quickly, I do think a factor that has been overlooked here by politicians is that small businesses actually benefit a lot from
TikTok?
Yes.
Huh. Well, it'll be interesting to see. Jing, very quickly, I want to talk to you about investment flows, because that's the other thing that's on the agenda right now, not just imposing tariffs, but looking at passive investment, that venture capital funds, that sort of thing, going into China. Is that something that you think is at great risk in the administration?
Well, there are lots of private equity venture capital funds that are still active in China, but they have also changed their strategies. Previously, they were investing in the high-growth Chinese internet platform companies, but now they want to partner with multinational companies in China because of their local expertise. So I think in this very dynamic era, companies and funds have to remain agile. Many of the funds, including the one that Fred runs, they are really partnering very closely with multinational companies. We see some potential multinational carve-outs. They're not exiting, they're just selling a proportion of their business to a local joint venture partner who can help them guide the future phase of growth. And in addition, I think a lot of the funds are contemplating how to find exits. Exits are harder. The marketplace is more challenging, so they may have to have longer-term capital rather than a limited, 5 to 7 year time horizon. So longer-term investments, I think, would be beneficial, but also for multinational companies, long-term strategy rather than short-term focus is also advisable.
Right. That has to be our last word. Thank you very much, panel, for your insights.